KCAA Loma Linda.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. I am Jeff Barton. This is the Mortgage Voice, and you can hear us here each and every week on KCAA. Out here, we've been out here about 9 years trying to deliver news about mortgages and real estate to the fine folks of the Inland Empire, the San Bernardino, Riverside County people, and some parts of LA, a little bit in Orange County, and certainly out into Palm Springs, up to 15 as well. If you're out in those areas and you're listening to my voice today, we are here every Saturday and every Sunday. If you're driving around, whether you're going to church, you're going to some kind of Home Depot on weekends, fixing stuff around the house, mortgages are one of those things that you've got to stay on top of because the rates, programs, and a number of other factors that will affect your decision on whether you're going to either refi, purchase, sell the house, whatever you're planning on doing for the future, maybe buy that income property. It all is dependent on what the updated information is in the moment. Now, we've seen rates rise like they've never really risen over the past 18 months. The Fed has given rise to their short-term rates. It's a tangential relationship between the two. But anyway, other than seeing me and hearing me on KCAA, you can also go to YouTube. I'm Jeff Barton, the Mortgage Voice on YouTube, and there is going to be this show as well as hundreds of other shows that you can see there dating back many, many years, see the history of what we do and how we do it. We bring many guests to the show, which you can also go to themortgagevoice.com and see those people, contact them directly if you would like to. Okay, so as I was saying, again, Jeff Barton, the Mortgage Voice, what we try to do, bringing you the information of the day, is to give you perspective. Now, there are a couple of ways that you can look at perspective. You can look at what's happening in the overall markets of the world, what's happening with inflation, what's happening with economies, what's happening with wars, and how that affects what's happening here locally. Or you can think about it in very specific terms. What product can I get? Is it a 30-year fixed? Is it 15? Do I have to go to the non-QM world? Not have to go, but do I want to go to the non-QM world? Am I looking at it as an investment to rent? What am I trying to do? And those guests that come on the show talk about programs, and we'll have a guest on today to talk about programs. We have another guest on today to talk about a type of loan product. So these two things is what the show is all about. So let's get right to it. Interest rates. So the interest rates on loans, they do tricky things all the time. Now, we had some reporting coming out this week, or came out this week, about inflation, and from the Consumer Price Index was pretty good. I'll get into that a little bit a while. But then the following day, we had news from the producers, or the purchase people, the wholesale index, and that was up high. So we had stock market react one way on Thursday. On Friday, it reacted a completely different way. Now, because what they call the equity markets, or stocks and bonds, react in such a way, it makes people happy one day, nervous the next. So if you're out there and you're listening to this and you're trying to figure out from the stock market or from these reports why the markets react the way they do, you got to stop watching it every day. Why? Because it's crazy, especially because the people who pick stocks, buy and sell on a daily basis, do it on the up, they do it on the down. And so there's going to be a football game-like atmosphere every time something happens that makes the markets go one way or the other way. Now, for you who's just trying to buy a house, or trying to sell a house, maybe you want to take some money out of your house to be able to invest it in something, you're just looking for a reliable, steady indicator as to what's going to happen with real estate prices over the next 6 months, what's going to happen with mortgage rates over the next 6 months, and will you be able to keep your job, or the renter that's in there paying for the mortgage and the DSCR programs for the next 6 months. This is how you got to look at decision-making processes when you're trying to get into the market for the first time, second time, maybe you're a seasoned veteran. But all these things are very, very dependent on a short-term analysis of what your needs are in the moment. So to digress, let's just go to rates here for a second. 30-year fixed rate loan is 7.14. The 15 years at 6.48. FHA is at 6.80. And by the way, the FHA product is not your friend today, because not only do you have the 6.80, these are all averages, of course, right? They're going to go up and down hundreds of basis points over the course of 2-3 months. So when you see 6.80, you're thinking, FHA is below the 30-year. Well, not really, because you have to add in there the mortgage insurance premium that they tack on top of that. Plus, there's a fee up front, which I believe is half a point. So, yeah, if you blend all that in, that rate's going to be a little bit higher, although you are insured, so that is a good thing. The 30-year jumbo is at 7.15, and the 5/1 ARM is at 7.0. So you can see by this measure, any measure over 7%, it's a big deal. Now, historically, and we talk about this ad infinitum, every other show we talk about it, historically, they're not the highest rates. We're kind of like right in the middle. There was a great article, and it was, again, because we have to mix politics in with all of this, because the choices that we make for those people who dictate what we do, they affect the CFPB, which is the Consumer Finance Protection Bureau, the Treasury, which Janet Yellen runs now, the Commerce Department, certainly over at the Fed, where Jerome Powell seems to be doing the dance, right? It seems to be making a lot of people less nervous, because it looks like there will be an avoidance of this dreaded recession, even though we have the flip or the inverted yield curve in the 2 and the 10, which, by the way, the 10 years at 4.162 and the 2 years at 4.888. Now, that narrowing, it usually is the other way. Usually you get the 10-year narrowing back to the 2, right? Well, this is the other way around. Regardless, that usually portends, or has historically foreshadowed, the coming recession. But it looks like we've got Jerome Powell in that mix of very, very few people, Paul Volcker being one of them, to make major policy decisions that affect long-term, to the surprise of many. Volcker raised rates up to, 22%, really killed inflation at the time. Everybody thought you can't raise prices when you're in a raised pricing environment. Well, it worked. And in this particular environment, the key has been you raise rates, but keep employment high. Nobody thought you could do it. That's why the pending recession, because it had never happened like this. Well, it's happening now like this. There are a couple of things about that. But this group, these people who are, in the political sphere, that's why we talk about politics. So there's this great article I read, and it talked about the different presidencies and the way inflation was, the way the economy was, and like that. And it was interesting, because the last two people who have been the current guy and the last guy actually were kind of in the middle of all this, in terms of the inflation rate, in terms of debt, in terms of the GDP, right? And so regardless of what you think about which party is better off running the place, they're both about the same in terms of this measure that I read in the article. If you go to Yahoo, I saw it, and I can't really remember, but you know how they do those historical analysis? I love them. You like those historical analysis, Daryl? Yes? No?
Constantly.
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 I just always like it, because it just goes to show you that really not a lot changed. I mean, there are some major changes in certain things that happened, especially with COVID, right? And by the way, the dreaded COVID is back. Did you read that?
I overheard at the pharmacy yesterday somebody talking about that there was a new strain.
Yeah, there's a new strain, and for people who are my age, maybe not Daryl's age yet, but anybody over 65, you're looking for the next shot, right? Something to protect you and I got all 19 shots already, so I'm waiting for the next one. And although, you know what? My hair got thicker since all these shots. Maybe that's a byproduct of the whole thing.
Could be. We're the same age.
I don't even know. Anyway, there's a lot going on in the world. I didn't get to 1/10 of what I wanted to say because I kept babbling on about other things. Anyway, the next segment coming up, we'll talk about that. We got some great guests coming on the show. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, to listening to us each and every week, talk about mortgages, talk about the economies, talk about historical analysis. We did in an earlier section. Anyway, thank you very much for tuning in. You know, we're on a number of different podcasts. You may or may not know. If you're a regular listener, you do know that we are on several. And Daryl, I don't know if we have that list.
Sure do, Jeff.
Great.
It says Apple Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, podclips.io, and of course, The Mortgage Voice.
TheMortgageVoice.com. You can go there and see this show as well as know a little bit about the guests we have on the show. You can contact them directly. It's called TheMortgageVoice.com. Also, podclips.io. You know, you search around, you hear a podcast. How many podcasts are out there? This is one. This is the one, this radio show is also a podcast, but there are hundreds of them. Where do you go to find a centralized location where you can just sort of browse a menu and pick several of these different podcasts in one place? Well, you can do it at podclips.io. They have lifestyle and sports and health and finances is the one I'm on. Many other topics. You go there, a lot of good professionals, people who know what they're talking about. And again, it's a centralized location to be able to do that, podclips.io. Okay, again, I'm Jeff Barton. This is The Mortgage Voice. Let's get to a couple of things that I wanted to talk about. One is the CPI number. That's the Consumer Price Index. It came out last Thursday. Very interesting. We see inflation in that number really coming down, and it's now at 2% rise in June from May, and 2% rise from June in the July numbers. The peak, of course, was at 9% on a year-to-year basis, and the 12-month basis for this particular index was 3.2%. So that really tells us what? It tells us that what the Fed is doing by raising rates is working. As I said in an earlier segment, the flip side of that is, okay, why don't we have unemployment? And there's been all kinds of reasons why people give. I think the main reason why we don't have unemployment is there's huge pent-up demand still. We're in the housing, and that's what we talk about, housing, mortgages, the availability of houses, the availability of mortgage products. They're scarce in both the mortgage products themselves, and that talks about the tightening of mortgage credit and why that's happening. It's because there isn't the demand that we would like to see in the mortgage interest rates, in the mortgage interest business, because the interest rates are so high at 7% and above. That really cools the demand, and because of that cooling of the demand, that's why we're seeing what we're seeing with no particular satisfaction. People aren't overbuying, even though house prices are really high. So a lot of this stuff that we talk about when we talk about the CPI, when we talk about the PPI, which again, as I said in an earlier segment, is up 0.3% in July, which was higher than analysts estimated, and the subsequent panic one day, happiness the next, or happiness one day, panic the next, is one thing that does occur all the time in the broad markets. So don't watch those markets. Just go to certain things like where you can be sure of whatever the inflation number is. If it is coming down, it means the Fed is doing what it's doing. It is working, and that's a good thing for most consumers. What we've seen is also food prices come down a bit more than what we had expected, and I think also we're eventually now going to see a drop in real estate prices, although to the opposite point, 30 of the top 50 markets in the U.S., metro markets, saw prices at the highest they've ever been. The highest they've ever been. Think about that for a second. Now, I live in Los Angeles County. My listening audience here lives in San Bernardino, Riverside counties, and the World Wide Web audience, which is everywhere, have seen prices across the U.S. really rise in every major city except those obviously have some other localized issues. Let's see here. Okay, unemployment, 248,000 for the week, historically low. 1.684 million continuing checks. That's also a historic low. And let's see, what else do I have? The Federal Open Market Committee meeting meets in September. This is the one report. We have one more report before we get whether we're going to see another rate rise or not. I tend to think we're going to see another quarter-point rate rise just because I think there is the lingering effect of the possibility that prices could rebound, and getting caught behind the eight ball again would not be a good thing. We do see some industries charging more, charging less, depending on their suppliers, depending on the demand out there. I just think we're going to see one more. And if my batting average is any indication of how it will go, just the opposite of what I just said happens. But my own personal opinion, my feeling about why the Fed would do that, keep it around 5.5 to 5.75, the borrowing rate, just to tamp down demand even more, which again slows the economy. There's other things in that I think are important to know. Let me see. Let's just see this. Okay, so there's a guy named Howard Schneider who writes for Yahoo, and it's Reuters, out of Washington, D.C. for Reuters. He wrote a great article. And one thing I think that is really unspoken is what a great job the Fed is actually doing to tap down inflation. It's impossible to really understand the breadth and the scope and the depth of how hard it is to do what he's doing without losing employment. Anyway, Howard Schneider, he writes, "We are in uncharted waters." Uncharted waters. Now, what does he mean by that? The current cycle is the first time over the entire post-war period the FOMC, Federal Open Market Committee, has made significant progress in lowering inflation without an associated increase in the unemployment rate. So you all have a job out there. You're all looking around to see, oh man, I want to buy that house, I want to buy that condo, maybe that piece of land. And the only thing you're worried about right now is the interest rate, because you're still working. You're actually probably getting a raise at your job because wages went up 4.4% last year, where we're looking at inflation below that. It looks like we're going to get a net gain in wages this year, which is a good thing. Usually causes inflation, but as we see by the Fed raising their rates, it's not going to cause inflation. But this is what this guy is saying. This is an unprecedented, and I think so too. I mean, if you look at the different recessions, I don't know how old you are. I've been through, I don't know, half dozen, maybe 10 in my lifetime. Never have you seen a recession end without high employment rate. Why? Because it's the only way that you can tamp down inflation and keep it low enough that you don't have to worry about an explosion in prices the way we had with the excess supply or the money that was infused into the system because of the pandemic. He also says, whether that sort of cost-free decline in inflation, that means without unemployment, can continue will be at the center of the Fed discussion in the coming weeks. Now, that's the policy meeting in September. Whether they have moved interest rates high enough or whether further rate hikes are needed. Okay, so my personal opinion, yes, they are needed. And I think it's needed because what's more important, keeping inflation down or keeping employment currently at 3.5%? Well, the Fed has shown us that you can have both. So I would say continue on the path, weather the storm of this ridiculous election that's going to be coming up next year, that we all have to get sidetracked on what's really going on for you. If you want to buy a house, you want to see rates come down, you want to see more houses on the market, and you want to see your job remain. Well, it looks like the job's going to remain. I don't know much about the way we're going to see mortgage rates come down, but other people smarter than me have predicted that next year we're going to see rates go into the 5%, 6% range. Right now we're in the 6.5% to 7.5% range, which obviously if we're lower in terms of the mortgage rates, we're going to see a lot more demand out there. So I don't know what that's going to do to prices, probably shoot them up. But anyway, these are the equations we deal with. But here, versus other places in the world? That's what I want to talk about next. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening to the show. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, for listening to us each and every week as I talk about what's happening in the world, how it might affect you, your decisions, what you're trying to do. Are you trying to buy? You're trying to sell? You're trying to get some money out of your house, but you don't want to sell your house? There are all kinds of different ways by which you can use the show to be able to further your decision-making process. And if you do that, you'll probably be better educated about what goes on in the mortgage and real estate world, and you'll also get to know us a little bit better. I'm Jeff Barton, and this is The Mortgage Voice, and thank you for tuning in. We bring to the show many, many people, and Nina Penny has been on the show many times. She's our reverse mortgage specialist, as I was talking earlier about different types of products, things that you can really benefit from, especially if you're of a certain age. Nina, how are you?
I'm doing great, Jeff. How are you?
I'm okay. Thank you very much. I'm a bit tired. It's been an up and down week. We've seen all kinds of things happen with both the economy and the politics. A lot of times I just sweep that stuff out and go, what can I do right now? So let's concentrate on how you're attacking your business and what's going on in the reverse world. Explain a little bit about what that is for the people who are listening.
So reverse mortgages cater to folks who are 55 and older and have a good amount of equity in their home. Now, you can use a reverse mortgage to purchase a new home, or you can use a reverse mortgage to tap into some of the equity built up in the home. So right now we're finding a good uptick in people wanting to utilize housing wealth to help them with the cost of inflation and the higher cost of day-to-day living. Also, a lot of people love a reverse mortgage, taking it out early and letting the funds sit until maybe they need it for in-home care or something much later on in life. So we do see a good increase right now in business.
I guess that's a good thing. I think the aging population, the baby boomers, I mean, how many baby boomers are still left working? I mean, probably a lot less than there were 10 years ago. So there's this huge pool of people out there looking for a way by which they either supplement how they live or use it for other purposes, whether it's medical or, you're paying for your grandkids' college education. Give me an idea of the process by which you interview and then you make decisions about the rate, the amount, all that kind of stuff.
Well, I mean, you always want to find the best option for your clients. I find a lot of times people have it and, maybe they don't have long-term care or, maybe they're afraid that the value of the home will decrease in a few years. So they find getting a reverse mortgage now so that it's based on the higher numbers. And so, when people are really looking to see how the product and a growth rate that's attached to the adjustable rate will take off over the years, that seems to be a really nice product for most people. We have fixed rate products. They're not as popular, but mainly because it's a lump sum at cash, at closing, and it doesn't, the payout is not as good as the adjustable rates.
Okay, the adjustable rate. I'm a little unfamiliar with the reverse adjustable rate. Can you just walk me through that?
Sure. So just like any other adjustable rate, if you've ever had one on your home, you have an index, you have a margin, and that equals your rate. And so basically it's based on that. And what happens is that it adjusts with that every month. And, today it might be higher, but when the rates go down, so will your rate. For example, if you take a fixed rate and 3 years of rates go down, you'd have to refinance, the whole loan to do that, to get the lower rate. With the adjustable rate, it will automatically adjust down as the rates go down.
I see. That's excellent. Also, don't they give out averages like 5-year, 10-year, 20-year average of what the adjustable is going to be? How does that stack up?
Well, we used to have a product that used to adjust every year. Now they've switched it to monthly.
I see.
You can't get a yearly adjustable, but you know what? We really don't do them because those rates are much higher.
I
So
see.
right now what we're really doing is really just 99% of my business is all adjustable rate.
I see. And people are, I guess, people who are savvy. Does it take a savvy investor to do that, or is it pretty easy to explain to people?
I think it's very easy to explain to people. I think
Right.
when people see the numbers
Right.
and they can see that the money that they don't use, that they leave in the line of credit, how that will grow over time, and they can see the benefit of if the rate goes down, so is their rate. And there's a 5% lifetime cap, so it can never go about 5% over
Okay.
what their start rate is.
Oh, okay. So there are some guardrails or safeguards built in, which is always a way by which you can, make people calmer. Obviously, if they have to make a decision on a reverse versus a fixed, most people would like fixed just because that's hammered into your head. But this adjustable is, I don't know what the start rate is in today's market, but 5% over that. But as you said, it probably will be going down just because, we've seen such a huge rate hike for the last 18 months, almost 2 years. What is the prognosis for that? Do you know?
Well, just like everybody, nobody is expecting 2023 to be a year of when we see the shift.
Right.
People do expect in 2024 that we will see the easing off or, maybe a break from not getting any more rate hikes. However, as long as the property values stay good, we can deal with a little bit of a higher rate because that really does offset it on the reverse mortgage.
Now, let me ask you a question. If the property value goes up, you said if the property value went down, you got in at a good time because you got the most out of it you can. What if the property value goes up? Do you then have to get a new mortgage if you want to take more money out? Because
Well, I mean, yeah, it's absolutely, Jeff. It's,
Okay.
You know what? If the property value goes up and there's more funds to access, then yes, you can refinance.
Oh, okay.
Just like on a traditional FHA loan, you don't have to pay that mortgage insurance again on the new loan.
Oh, that's a
So
good thing. I didn't know
that is
that.
a good thing. Yep.
Now,
So-
do you have a cap on how much money you can take out?
At closing, you can take up to 60% on the adjustable rate
Okay.
of the balance, and the amount that you have access to is based upon the value of your home, your zip code, and the youngest person's date of birth. So we always estimate that people are going to live to be 100. So
Okay.
the older you are, the more money you get. The younger you are, you'll get less because your life expectancy is 100.
I see. Well, that's very interesting how that actuarial table works.
Yeah, it is. It's the LTV or loan to value is based on your age.
I see. Okay, very good. All right, now, qualifications, credit scores, is it just about the property? What do you have to come to the table with? I know there's some taxes involved and maybe some other homeowners association or other things you have to say that you can pay or prove that you can pay. What else do you need to do?
Well, basically, we work off of residual income. So let's
Okay.
say, Jeff, you make $2,000 a month,
Right.
right? And you have, $500, and you're by yourself, right?
Right.
And so you get $2,000 a month, and let's say a $500 car payment, and maybe taxes and insurance altogether come out to, let's say $1,000, right?
Right.
So basically what we do is we look at the fact that you have $2,000 and that you would have to have $595 left over for residual income. So based on this, if you had equity in the house, you would qualify.
Okay. Okay, that's a good thing. Qualifying is always a good thing, especially if you're old and retiring and everything else. You need to know that you can have not only equity taken out of your house, but the more the merrier.
Absolutely, yeah. You never have enough buckets when you're retiring.
Absolutely, and cash is always a good thing, and that's why I like the product, because you can access the money in your house, and you never have to worry about anything about the house.
Yep.
And that's a good thing,
And
too.
you still get to enjoy it.
Right, exactly. Okay, Nina, we're up against it. Could you shout out a way by which people might be able to get in touch with you as the go-to person for reverse mortgages?
Sure. You can always call me or text me at 480-635-2410, or you can check out my website, and that's simplereversemortgage.net.
Excellent. Nina, thank you very much for coming on the show. I always enjoy our conversations.
Me too, Jeff. Thanks again.
Thank you very much. That's Nina Penny from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We are here each and every week bringing you information to help you decide what you're going to do. You're going to buy that house? What's the rate going to be? What's the program? Who do I go with? Who do I trust? Do I have a real estate agent? Is there a property available in my price range? All of these things we try to address at both the macro and the micro level. And you know what? If you want to see and hear this show, go to YouTube, Jeff Barton, the Mortgage Voice. We have hundreds of shows there archived, as well as the current show, and we've been doing it for the last 9 years. So we have some expertise in how to deliver to you information in many, many different ways. Jeff Barton, the Mortgage Voice, is just one of them on YouTube. Anyway, joining us once again, Ryan Baggin from 11 Mortgage. I like to have him on because he's always innovative and has some creative solutions to your mortgage needs. Ryan, how are you?
Cannot complain, brother. How you doing, Jeff?
I'm just fine. Thank you very much. Okay, so now that I've given you the big buildup, let's talk nitty gritty. What's going on in the mortgage business with products? We hear that there's a tightening going on out there in terms of the products available. That money itself is costing more because the rate's going up. Where do we find relief?
Well, you know what? You are right. There is a tightening.
Mm-hmm.
The borrowers are getting tougher.
Mm-hmm.
The AUSs, the desktop underwriting, the underwriting process is getting a little bit tougher. People are getting a little bit more stretched to their max. DTIs are higher. We're getting a lot more refers, things of that nature. But you know what? The problem is the prices in California. We're predominantly in California.
Mm-hmm.
Inventory is really tough, and there's a lot. It's basically affordability. We always go back to affordability. That's the problem in California. It's affordability. The rates are at 7.25%, right?
Yep.
So now instead of having a 2.25%, let's say 4.25% rate, you're doubling your payment. Everything is getting stretched very thin. That's the biggest problem that we're facing.
Now, because you guys do all kinds of different mortgages, tell us a little bit about some of the products you do, so that then we can get into the discussion about, okay, so if this is the problem, what are we all doing about solving the problem for the borrower who does want to buy but maybe doesn't fit into the credit box that is currently available?
Well, we're pretty vanilla. We offer FHA, VA, conventional, USDA. We have some non-QM products, but then those products are much higher than prevailing rate.
Right.
The biggest problem that I'm facing in California is inventory. All my accounts in Texas, Florida, West Virginia, North Carolina, Tennessee, volume is much higher because there's a lot more volume. There's a lot more
houses for sale. Right.
Inventory, exactly. Inventory, right? So if you look at a 12% rate on a $250,000 house, the payment is much more affordable. When you look at I'm not saying 12% is the rate that's prevailing right now, but I'm just using it as an example.
Yep.
But if you look at a 12% rate on a $700,000 house, the affordability factor is much more condensed, right?
Right.
So you don't have the money to buy a new refrigerator. You don't have money to buy Wi-Fi. You don't have money, like all these other expenditures that you don't really think about when buying a house. So at the end of the day, I hope we're going sideways and we'll come down here a little bit, but I don't think 2023, is going to be very beneficial to the first-time home buyer, unfortunately, unless you're an equity sale. But at the end of the day, we have what we're shifting towards is the down payment assistance programs that are offering the ability for buyers that don't have the money but have the ability of they're paying a $2,800 rental payment, But you know what? They're going to pay $3,100 to buy their own house. So we're offering them the assistance to get into that house without having to bring that money in at closing. So that's what I feel is going to be for the next, the rest of the year is going to be, a huge product and very beneficial to California. It's actually 49 states that we're offering it in, so it's very beneficial to a lot of states.
I just read that Wells Fargo is offering up to $10,000 for selected first-time home buyers. Forgivable second.
Wells Fargo, Citibank, because they got popped with their portfolio because they're too jumbo heavy.
Okay.
Low income tracks. It's called the home run program. Basically, they're paying so that they can get their portfolio in line. Otherwise, they keep getting penalized. They're literally giving 1% under. Let's say the rate is 6%. They're
Right.
giving 5% and giving $7,500 credit. That they're literally buying that paper because Citi, Wells Fargo, U.S. Bank are really predominantly jumbo investors.
Right.
They always woody up the jumbo paper, like very aggressive, right? But now there's a lot more scrutiny on what they're doing, and they're saying, hey, you're not lending to this area, which is typically lower income, things of that nature,
Mhm.
right? So they're not doing conforming loans. They're only doing jumbo loans or portfolio loans, and now they're getting penalized for it. So what they're doing is they're buying that market heavily.
I see.
I
Interesting.
have a senior vice president, one of my very good friends, and they literally, if I throw a conforming scenario at them, they just they eat it up. But they don't have that business, So
Right.
it is what it is. They're trying to balance the portfolio.
Is this why the interest rate on the jumbo has really shot up? I mean, it used to be competitive with some of the other rates, but I've seen, we're looking at the jumbo rate at about the same as the 30-year fixed.
Well, U.S. Bank literally just fired all their producers in jumbo. Their balance sheet is completely sideways. Citibank is still doing a decent job with it, but all these big institutional banks, they have so much paper with low interest rates, and the value for that paper has dropped based on the 10-year spiking.
Yes.
So they're
Yes.
they're going to get, if you give me 6 months, and they're already downgrading a lot of these. The U.S. Bank got downgraded, or it's on the block to get downgraded. Downgraded by the.
Their mortgage-backed securities, the ones that they're sold, or the ones they're selling, or both.
They're holding. No, they're holding so much paper.
I see. Oh,
U.S.
okay.
Bank just acquired Union Bank.
Yes,
okay?
they did. Yes, they did.
So their balance sheet is completely sideways. Okay, we'll use that term while we're on the air, right? But
Right.
a lot of these big banks are holding the bag, and the higher the 10-year goes, the higher the rates go, the
less
lower-
anybody wants that other paper. No, that makes total
Exactly, 'cause
sense.
If you're at 7,
Right.
If you're at 7, why would you buy paper that's at 3.5?
You wouldn't, unless they heavily discount it.
Exactly, but
Right.
then when you go from $1 billion to $600 million, you get a $400 million loss on your balance sheet. What happens when you have that times 20? You understand?
Mm-hmm.
So they're really pulling back on the jumbo. No one really wants that. Wall
Right.
Street will touch it right now, but they're charging 2 to 3% over the conforming rate. But that's where I feel we'll see the most tightening. But it is what it is. At the
Yeah,
end of the day,
I think what you're saying is very educational. We spent the last show talking about why the 10-year and treasuries, and when they cross, it's a problem because there's no place for where the mortgage rates can go unless you see the 10-year dip. And that's why when we look towards pricing, we look to the 10-year. We don't look to the 2-year. We don't look to other indices because you're in competition with that 10-year on the bonds either you're trying to sell or the paper that you're holding.
Exactly. So it's either going up or it's
Right.
going down. You know
Right.
what I mean? Because what you're holding could be going down in value, but and because the yields are going up.
Yeah,
So
right.
it's
And the
basically,
cost
I
is
look
going
at it-
down, so you're
Yeah.
spending less and making more. That's a good thing for
Yeah,
the consumer, but bad for you at the bank.
Well, at the end of the day, we've moved away from servicing so much of our paper because we know there's so much volatility.
Right.
So we are servicing a portion of our business, but we're not one of the guys that are going to hold the whole. We're not going to hold all of our servicing because we understand that the servicing volatility where it's at with the rates going up and down, and the volatility in the market is so crucial that we're not going to, we're here for the long haul. We've been in business for many years. And at the end of the day, if someone's willing to buy it and we're making a profit, then, we might as well sell it to that guy, So
Right.
that's how we kind of look at things at this,
No, it's
as you know, with the correspondent business. It's
Same
dead
thing.
because
right.
too much
That's dried up.
volatility, You're not going to get caught holding the bag.
That's
Very-
right. That's exactly right. And a lot of mortgage brokers who are also bankers like myself, that's what we do. We look at it and we go, you know what, let's just broker for a while because there's no reason to hold the paper even for a day or a week. What's
No,
the
not
point?
at all. Because tomorrow you wake up and,
Right.
The market has completely gone down, and you're like, "What the heck happened?"
Yeah.
You know what I mean?
And your
then
investor
you're
goes, "I'm not
liable
buying."
for
Right.
$5,000 and $10,000. It's not worth, it's not worth your time.
Right. Hey, Ryan, we're at the end of it right now. Thanks for that great conversation, by the way. The audience loves it. They chew it up because they really do understand the nuances in the marketplace and why things happen, and we're always here trying to educate. Anyway, thank you very much for coming on the show. If you could let people know the best way that they can get in touch with you directly, that'd be great.
Awesome. If anyone has any questions, you can contact me directly at 661-414-4730, or shoot me an email if you have any questions regarding the market, rates, whatever the case may be, at Ryan, RYAN.Bagan, BAGAN, at 11mortgage.com. And my preferred broker is Malibu Lending.
Excellent.
Thank
Thank
I
you.
appreciate you.
Thanks very much, Ryan. I really appreciate it. That's Ryan Bagan from 11 Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in and listening to us here on The Mortgage Voice. If you want to see the show, go to YouTube, Jeff Barton, The Mortgage Voice. If you want to hear the show, there's a lot of different ways that you can hear it. KCAA is the #1 station on our radar every week. We broadcast from them, have been doing out in the Inland Empire, KCAA.com. And you can also, what are they're on FM, correct?
They're both AM and FM. They're on AM 1050, and they're on FM 106.5.
Okay, Saturday and Sunday, you're driving around, you're going to church, whatever it is that you're doing on the weekends, you can tune us in on each one of those stations and get the information that you need, especially if you got to make decisions right now. Hey, kids go to school like next week or the week after, so if you haven't already decided on your housing issues.
Yeah, I was just going to say, and like you, they're also on the web at kcaa.com.
Yeah, absolutely, KCAA.com. Anyway, I'm Jeff Barton. This is The Mortgage Voice. Let's just jump right back into some of the news to use section. Mortgage fraud rises 532% from Q1 to Q2. What does this tell you? It tells you desperate times. You know what happens. You've got rates rising. You've got house prices rising. You've got the difficulty with which people who want to buy are getting approved for a loan. People stretch. We heard from some of our guests this week as well as last week, the week before, that product out there is fewer products are out there because there are fewer buyers out there. So why have that kind of risk in the marketplace if you're really just trying to turn and burn a loan and get it sold on the secondary market? So if you are out there and you are desperate trying to find some loan, the temptation that you have, or your mortgage loan officer or your lender, whoever it is, to do something in order to get paid. You get the house or you get the refi, the mortgage broker, mortgage banker, loan officer gets paid a mortgage commission. Yeah, so it is on the rise at 532%. You know, there was about 5 or 6 years ago, and there was a little repeat of that recently. There were a number of loans done when the borrower would present income documentation, websites, employer verifications, all fraudulent. They'd make websites that weren't real. They'd dummy up W-2s, and they'd have false phone numbers so that when the lenders would check for verification of employment, they would get somebody on the phone. So all of these things are what has happened in the past, and like all things in the world, whether it's fashion or food, yes, we see certain frauds come back to us again and again. And this is one of the main frauds that happened, about 2015, 2016. So that is what, 6, 7, 8 years ago. So if you're out there and you're contemplating trying to get something that maybe really shouldn't get, think again, because it always comes back to getting caught or having some sleepless nights and heart palpitations and all kinds of health issues because you know what you're doing is wrong. Anyway, just be careful with that. Wildfire risk. Okay, so everybody has heard and seen what's going on over at Lanai. Awful, terrible. Hawaii is a great place. I know Maui, been there many times, and it's just paradise, really, and to see that kind of devastation go on. But we know that here in California, whether we have floods in the spring or whether we have fires in the fall. It happens every year and has been happening here in California forever. I've lived here for over 35 years. It's always, every year, somebody's burning down. What are the consequences of that? A lot of insurance companies getting out of the state. Problem, right? You need insurance or you can't get a loan. Okay, that's secondary problem. But you need insurance because, heck, stuff happens here, whether it's wind or fire or rain or whatever it is, earthquakes. So we haven't even talked about that because we haven't had one in a while. And, of course, now I've jinxed it. But regardless, you have got to have homeowners insurance. State Farm is out. I think Geico is out. I think Progressive is out. I still have my homeowners insurance Farmers, but my agent told me this year they're getting out. So California Fair Plan, that's all that's left, but they are not the greatest policy, but it's the only policy in town. Just be aware that when you're obviously doing a loan or you want to get a purchase for a house, if you can get a company to insure you, the prices have gone through the roof. Mine went up $4,000 this year. Think about that. Now, granted, I live in Malibu, California, so I can't really complain, but for those of you who are out there in certain areas of the country, certain areas of San Bernardino, Riverside counties, you know where your fire hazards are and where they're going to come from and whether you're in the fire zone. And obviously you're already on Fair Plan, but many of us are headed there as well. The mortgage delinquency rate falls to the lowest rate since 1979. Given all the things that are happening to people who want to get a mortgage or things that are disasters, those people who have mortgages are paying those mortgages. Why wouldn't you pay a 3% mortgage? Come on, wake up. Hello? 5% and down, 543. Yes, anybody who has those mortgages, they're going to pay those till the cows come home. And believe me, they're coming home. No, they're not. I don't even know what that means. But if you have those, that's why the delinquency rate is so low, because you don't want to have any chance that somebody's going to, one, take away that terrific mortgage, and two, you've got built up equity in that house already. Even if you bought it 2 years ago and it was 3.5%, your equity is up 10, 15, 20% right now. That's why that is happening. 3 separate suits over real estate buyer commissions through the MLS. We predicted maybe 8 to 10 months ago that the real estate commission structure, the way it has now, how you buy a house, is that you find an agent and they work hard for you. They run around town, they show you 100 properties, you see, 1,000 online, whatever it is, they're working hard for you because they know if they sell you a house, i.e. you buy a house, they're going to get paid a commission through the seller because the seller is granted their agent 5% and that agent splits it on the MLS 2.5% to 2.5%. Well, there's several lawsuits out there that said, no, that's stupid. Why is the seller paying for the buyer's agent? So there was a recent settlement that it's gotten held up in Massachusetts about this. Now, this affects, obviously, if one gets settled, they'll all get settled. But how does this affect you as a buyer? So if you're a buyer out there and you now have to pay your agent separately, your agent probably wants to negotiate a commission with you up front. And whatever that commission is negotiated, they're going to want a certain time limit on the particular contract, because all contracts have to have as one of its key elements a time that it starts, a time that it ends, the amount of payment for the amount of service. That's a contract. That's what contracts are. So if this does go down, it's going to make the buying process harder, because you're not only going to have to commit time-wise to your agent, you're also going to have to commit dollar-wise to your agent. And a lot of agents are going to want to get paid as they go, as opposed to a flat fee if you buy. And just word to the wise, this is coming down. Hopefully it'll get negotiated out, but I'm not sure. And as I said 8 months ago, this will change the nature of buying and selling real estate. Great for the seller, not great for the buyer. too many real estate agents and LOs. That's the next topic. Yes. Do I think there are too many real estate agents? Yes, I do. Do I think there are too many loan officers? Yes, I do. However, it is a great way by which you can shop. And, if you have one agent that's going to charge you something and you have another agent that's going to charge you something else, that's the number one reason why you pick a real estate agent, is because of the cost. You're thinking anybody can sell this, especially in a market like we have today where we have multiple offers and prices going up. Why do you need to shop? You just need to make sure that who's ever charging you and whatever they're charging you, and they've got some kind of track record, is the lowest on the block. That's the way it is. Now, I know a lot of agents puff their chest out and say, no, it's me. I know better. I know how to sell. No, the property sells. Everybody knows that. You either want it and can afford it and buy it, or you don't. Negotiation is a separate thing. Yes, that does take some skill. However, in certain markets where you have a market like we talked about today, where 30 of the top 50 markets in the country, we see the highest prices ever. How much negotiation room do you really need if you're a listing agent? You don't need much, because you can just say no contingency, highest and best, and that's it. That's all you have to do. Okay. Commercial loan world. We got another 30 seconds here. The commercial loan world is killing U.S. cities and U.S. banks. We heard a little bit earlier about some of the mortgage products that are being held by certain banks and how that's hurting them. Well, the commercial paper and commercial banks are killing them. And we have a number of defaults probably coming due. And what is going to happen in commercial real estate? We've seen a certain percentage of them go to residential. Trying that conversion must be a nightmare. Can you imagine how much money you got to sink in before you figure out that even in residential you're not going to make any money? Anyway, that's what's happening in the real estate world. I didn't get to 90% of what I wanted to talk about, but that's quite typical because I just can't stop talking. And I am really talking for you because I really like the show and I like talking to you about real estate and mortgages. I'm Jeff Barton. This is The Mortgage Voice, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Legacy 1050 AM, Southern California. NBCRadioNews.com.